Real estate investment presentation. Price level adjusted mortgage, or PLAM. Get ready because we're raising the stakes with real estate. As we continue on with the price level adjusted mortgage, or PLAM, remember that working practice problems is a good way to better understand these concepts. Also remember that whenever we look at concepts, there are going to be deviations from the norm. In this case, the norm being the 30-year fixed mortgage. You want to keep that in your mind as the baseline, and that'll give you a starting point to see where the deviations are coming from, in this case with the price level adjusted mortgage, or PLAM. Note this is a terminology, so we're going to be referencing Investopedia, which is a place you can go if you have investment-related terminology, continuing your research from there. So the price level adjusted mortgage, or PLAM, is a graduated payment home loan. The principal adjusts for inflation. So we have a similar concept with the adjustable rate, or ARM, or in other words, if you think about the baseline, that being the 30-year fixed type of home loan, then you might say as the borrower, hey, I'd like more favorable terms, I would like a lower rate and or lower payments. Then the lender may be able to provide that by taking a deviation from that standard loan setup and removing some of the risk from the lender to the borrower, risk related to, in this case specifically, inflation in the future. And in so doing, typically then being able to offer possibly a lower rate and lower payments, although there will be adjustments in the future. Now with the ARM, which is probably a more standard type of format, we have the adjustments happening to the rate. This time, however, the adjustments aren't going to be adjusting the rate, but the actual principal. So if you think about the amortization table, you can think about actually going into the amortization table from time to time, not adjusting the rate, but adjusting the principal, and then you're going to be adjusting the payments based on the new principal with the same rate on a time period by period basis. That adjustment to the principal is going to be related to inflation, as inflation typically increases over time. So that's the basic idea. We'll get into it in a bit more detail here. So the bank or lender will not change the interest rate, but will revise the home buyer's outstanding principal based on a broader inflation rate that is derived from a price index. So it's a little bit strange if you've worked with these amortization tables, especially if you've used those adjustable rates where you've actually adjusted the rates from time to time. This time, again, we're adjusting the principal instead of the rate. So price level adjusted mortgage, we have many mortgages have adjustable interest rates that vary based on fixed interest rates or certain market indexes. Those would be the type of ARMs. So again, if you take a look at the fixed rate, the deviation from it, most of the time is going to be an ARM, but you do have this other option which could have some pros and cons to it, where the rate will not be the thing adjusting, but the principal. With these conventional mortgages, the balance remains fixed. So in other words, when you think about an ARM where the rate is changing, the balance remains fixed. That doesn't mean, of course, that the balance of the loan is going to go down. But if you think about the construction of the amortization table and you think about adjusting the rate, you will not typically go into the amortization table and basically adjust the ending balances when you're thinking about an adjustable rate or ARM. You'll adjust the rate instead, which will have an impact on the payments going forward. In this case, however, we're not adjusting the rate. We're actually going into the ending balance on a period-by-period basis and adjusting the ending balance, keeping the rate the same. However, with the price level adjusted mortgages, the interest remains fixed, but the outstanding principal balance fluctuates. So how a price level adjusted mortgage, or PLAM, works. Lenders receive back the loan principal, a determined interest amount, and an additional price that covers the cost of inflation. That's going to be the basic concept of it. Under the normal economic conditions, inflation causes the original value of a home to increase over time. So we got to get just a general concept of inflation, make sure we got our idea of what inflation is. It's not exactly the same thing, of course, as the interest rates, although the interest rates will be impacted by inflation. In other words, if we're in an inflationary period, you would expect then the interest rates to be going up. If we're in a deflationary period, then you would expect the interest rates generally to be following and going down. And the inflation itself, however, is the devaluation of the dollar over time. So in other words, $1 can buy less stuff in the future than today. We will typically have inflation when we look at the U.S. Any currency will typically have inflation. But if we think specifically at the U.S. here, the United States, then the inflation will typically, they're shooting for around 1 to 3%. They like to keep the inflation somewhat static. You would like, ideally, there not to be any inflation, it just to be a static dollar amount, fixed amount. Therefore, we have a fixed measuring tool on which to value things. However, that's not practical because we don't know exactly how to do that, and we do not want to have deflation from the dollar, it going down, because that could be not good for the economy. So you want enough money in the economy to at least keep things stable, and they tend to want to overshoot then for like 1 to 3% of inflation. So you would expect, if they do everything right, that you would have inflation. It would always basically be going up. It would be between like 1 and 3%. However, you can't depend on that exclusively, especially over a 30-year time period. You will probably have points in time where the inflation might be higher than that at certain points in time. And if that were to happen, then of course, that uncertainty is what is difficult when you're going into a long-term contract for a loan for, say, 30 years. And that uncertainty being transferred from the lender to the borrower is part of what allows possibly the lender to give more favorable terms up front. So this gradual climb can be significant if it happens over the course of the long time. So increases in home equity will usually offset the home's value rise. So notice that as inflation goes up, that means the purchasing power of the dollar goes down. Things also typically become more valuable, or there'll be more dollars needed to buy things like houses. So you would think that in an inflationary time period, you might have adjustments to your mortgage at that point, because that's what it's for, so that it will protect the lender. But you would also think that those kind of adjustments would be washed out or covered by the increase in the equity in the home, because the home value you would expect to be going up as well if you're in a period of inflation. Before opening the price level adjusted mortgage, or PLAM, the home buyer and lender will reach an agreement on how often the lender is to make inflation adjustments. So if you're starting out on this loan, then of course you got to be more careful as the borrower, because a lot more of the risk now is going from the lender to the borrower, and the agreement that's going to be made up front is of course in exchange for that risk going from the lender to the borrower. You should get more favorable terms, at least up front at the start, unless inflation hits, in the future, and then you're going to have to determine what type of calculation will be used in order to calculate the inflation, so that you could do those calculations in the future. And you have to determine how often those calculations will take place, meaning, are they going to happen on a yearly basis? Are they going to happen then on a monthly basis? Therefore, as the borrower then, you need to do more kind of what-if type of analysis, best case scenario, worst case scenarios, determine what you think is going to happen, and if it was a worst case scenario, can you still get by if that were to take place, and so on. So in most cases, adjustments happen actually monthly. So then lender makes these adjustments based on the movements of an appropriate price index, like the Consumer Price Index, or CPI. So the CPI is going to be used as a measure or a judge of what inflation is. Now remember, inflation in and of itself is not something that we can tie down specifically to what it is, because even the government, of course, is trying to determine what inflation is by measuring a basket of goods and so on and so forth. So they have to make some kind of estimate of what they believe inflation is, and then of course we're going to use that same calculation, that estimate, in order to do the calculations and adjustments to the loans. So advantages and disadvantages of a price level adjusted mortgage, or PLAM. The home buyer can benefit from keeping their interest rate at a consistently low level for the duration of the loan. So instead of increasing the interest rates as you would see with an ARM, they're periodically increasing the balance, which will have an impact on the payments. You could do an interesting comparison between an ARM and a PLAM. You would think in times of inflation, you would also have increases in interest rates. So both of them would be then going up. You would expect the rate change, if you're looking at an ARM, would be an increase in the rate, which would have an impact on the payment. And then if you're looking at a PLAM, the inflation would be increasing the balance, which would also have an impact on the payment. Now you expect, at least early on, that the increase would have a bigger impact on the ARM, meaning if the rate was adjusting, the increase in the rate may have a bigger impact on the increase in the payment. than an increase to the balance would. But there's kind of an interesting relationship with these types of loans on how the payment structure works, because they're still structured to end after 30 years. So you might end up in a situation during that 30-year time period where the actual balance goes up above what the original balance was of the loan. But because each time we calculate it, we're actually calculating it to end at the ending point in this case being 30 years, then we can have an increase basically at the payments towards the end of the loan. So it's kind of an interesting structure that happens on the payments. We do graph it out in the practice problems. We do have worksheets that you can work out these problems, and we also have a example sheet that you could use to kind of test them out and use if you want to compare and contrast with it. So the low rate consistency helps make the mortgage affordable at all stages. Since the lender doesn't incorporate expected inflation increases in the mortgage structure up front, the borrower starts out with a lower interest rate and lower monthly mortgage payments than they would find on many conventional mortgages. In other words, if you're going to lock down the rate, which is the conventional 30-year, then the lender, because they are of course taking on then the risk of the increase in inflation over time, have to then incorporate that risk, what they think is going to happen in the future, and they may be right or they may be wrong, right? They got to incorporate the risk, meaning they're going to think about what will actually happen, and they'll also think about the risk of what could possibly happen, typically on the worst side of things, and add that into the rate that they're going to have as a fixed rate throughout the life of the loan. Because you're taking that risk away from the lender and now you're assuming it, then they don't have to add in that inflation risk for a 30-year loan, which can be significant, resulting in lower rates up front, and then as inflation happens, it would go up with inflation. So the borrower will not have to contend with the sudden substantial mortgage increase later on, because the lender will never increase the interest rate. So again, you would think that the increase in the interest rate is the thing that could actually increase more suddenly the payment amount, although an increase in the balance will result in changes in the payments as well. So more advantages and disadvantages. The lender benefits from being able to raise the loan balance based on inflation increases. So obviously the lender benefits because they have that safeguard with regards to inflation. A disadvantage is that the borrower has less predictable payments. So clearly the payments are going to be changing over time. So they might not be changing quite as dramatically if you had a giant increase in a rate change, but they would typically, you would expect, to be going up over time, and you can't really standardize the payments as easily as if, of course, they were fixed. Whenever inflation sends the unpaid principal higher, the bank will revise the borrower's monthly payment upward as well. This change means homeowners will have the prospect of slight monthly increases to their payments for the life of the loan. So the variable rate mortgage payments can make it harder for homeowners to plan and budget expenses. So obviously, if you're planning and budgeting, it's nice to have a set amount that's going to be going forward, especially if you can make those payments kind of automatically coming out of your account, or automatically recording them on something like your accounting system or software. If they're changing all the time, then they're usually going to be increasing if you're in a period of inflation. So you have to have those slight changes and make sure that you can still cover them. And of course, you got to deal with the fact that you're going to be writing, if it's done monthly, a different monthly check as the inflations are changed on that period basis. So this is why the PLAMs are less suited for borrowers living on a fixed income.